Can you guys hear me okay?
Yes, sir.
All right, perfect. How's it going, Ronald?
Everything's good, buddy.
Okay, cool, cool. So,
How
guys,
about with you?
we're just burning one more minute before we get started here. Just wanted to ask you guys takeaways. What are you guys hoping to take away from today's class? I want to make sure we cover it. Anybody? Shanika, how about you? Or Pam?
Good morning. I'm just looking to see what the current down payment options are for units.
Okay, nice, nice. Cool. We'll definitely cover that. And Shanika, how about you?
Yeah, hi, good morning. Uh, the same thing as well as the rental income and how it can help you qualify.
All right. Okay, nice. All right, well, you guys are in the right class. Just wanted to make sure. All right, cool. So let's get it started.
Party there. After the party, it's the hotel lobby.
I'm sorry, that's my theme music. It just follows me wherever I go. But welcome to Monarch Mortgages, debunking the myths on buying units, purchasing 2 to 8 unit properties. I'll be your moderator and also and a participant in today's seminar, along with Arlette Hamilton and Ken Smith. We're going to talk a little bit about Monarch Mortgage. We are growing as a company. We are a small mortgage brokerage out of Inglewood, California, but we're mighty. Okay. We have about 11 people on our team now, and we're continuing to grow. And, we're also growing in states. So we'll share that a little bit later. Programs that we offer. I'm not sure if you can notice, but we offer pretty much everything. Okay. FHA, conventional bank statement programs. We have 203K for FHA that's not listed on here. We have 1099 only, self-employed programs, no income doc programs, DSCR that we'll be covering today, down payment assistance, also known as DPA. We also do refinances, home equity lines of credit, home equity loans. So we really do it all when it comes down to mortgages. Okay. When we talk about being a mortgage broker, one of the major benefits is that we have lower interest rates than retail banks. So basically, when you compare us to Bank of America, your credit unions, we're right in there. We've beaten pricing from credit unions and also major banks. So, when you refer somebody to us, don't think you're going to get a higher payment or something of that nature. It'll, in most cases, be a lower payment than what they will get elsewhere. We close your loans in 14 days. We have the ability to do that through one of our partners that allows us to get a CD out at initial underwrite. So we're able to get loans done in 2 weeks. I'm on my third one right now. I will let you guys know how it goes. We should have a clear to close. And it should be day 11 today. Okay. So, we're closing loans extremely fast. It's a competitive advantage for those of you who are trying to win over deals, and that can be done even on units. Okay. Great customer service. You're working with us. We are knowledgeable. We speak directly to your listing agents. We answer the phone after hours, and we have a great pre-approved to close loan right now. Still working on my 2025 numbers, but in 2024, 96% of the loans that we pre-approved and opened escrow closed. Okay. So the industry average is about 75%. So we are above average when it comes down to pre-approving your clients. Okay. Right now, we're licensed in multiple states. We're not just in California anymore. Nevada, Texas, Florida, Michigan, and Pennsylvania. Okay. It is also my goal to add 3 to 5 states every single month, year. So every year, we're looking to expand into more states. Okay. So we're growing, guys. Just keep that in mind. And if you know anybody relocating to Texas, buying investments in Michigan or Pennsylvania, Florida, Nevada, feel free to keep us in mind because we are licensed in those states. So this guy here Man, I look better in the picture, huh? Oh, so sorry. I'm sorry. I got it. All right, just got to keep it a little entertaining, guys. So, my name is Carl Delaney Fiesta. I'm a mortgage broker, broker owner of Monarch Mortgage. I've been in business for 4 years as a mortgage broker, but have 13 years of experience doing loans. I started back in the countrywide days, 2005, 2008, got out in 2015, worked with another mortgage broker to a direct lender, New American Funding, Legacy Home Loans, and then finally decided to start my own mortgage brokerage. And it's sky's been the limit ever since. Okay, so that's a little bit about me. Also, education, went to Cal State Northridge with a business degree in marketing. So that's a little bit about my background. And let's hop into myth number one. So you need to make a lot of money to buy units. Anybody can answer this. You could throw it in the chat if you're being shy, but don't be shy. Being shy doesn't make you money. Okay, so let's go ahead and not be shy today, because we're trying to talk to people about why they should buy units, and it starts with you talking about it. So, do you need to make a lot of money to buy units?
You gonna mute? You want to
Yeah.
mute, Carlton?
No, I muted myself because I was waiting on y'all to answer the question. But Shanika did it in a chat box. So Shanika says no. You don't need to make a lot of money to buy units. So typically when you're buying units, because you can use rental income to qualify, you typically have to make less money than you would need to purchase a single family residence. Okay. So that's one of the concepts that we're going to be covering today. Okay. So why buy units as your first property? So this is kind of like a 4-unit property here. If you can see these doors, okay. All right. So lower monthly payment, access to owner-occupied loan programs, learn landlording with lower risk, build wealth earlier in life, easier transition to future investments. One of the biggest things I want to focus on is building wealth earlier in life, because this is affordability. The reason why people should purchase units as their first property is a few reasons, but one of the first reasons is that the monthly payment is typically lower. Okay. And I'm to help you with that example, we're going to move forward to this graphic. Why buy units as your first property? So if the total monthly payment is $8,000 a month, and you have this unit paying $2,000 a month, and you have this unit paying $2,000 a month, and you have this unit paying $2,000 a month, what's your monthly payment? $2,000 a month. Thank you, Shanika. So yes, that's the concept, right? Yeah, the mortgage payment is 8,000, but your portion is 2,000. Now keep in mind, people move out and things like that. It's not like a fixed number because you have tenants. Some people stop paying rent. There is some risk associated with it. But if you get the right property, you could definitely end up in a situation where you're paying about 2,000 on an $8,000 mortgage note. Another example, after living in the property for 5 years, let's say that the first tenant moved out and now you're charging them $3,000 a month. Second tenant moved out, you're charging them, the new person, $3,000 a month. The third tenant decided to stay, still paying $2,000 a month. How much is your mortgage payment now? Don't be shy, guys.
Zero.
Thank you so much. Absolutely. Zero. So that's covering the total mortgage, right? And of course, if you move from the property, similar example, you could end up netting about $3,000 a month on this property in this scenario. Okay. If you were to move out of that unit, rent it for $3,000 a month, the first tenant's still there. But you could end up in a situation where it starts to make you money, right? Not to mention, of course, mortgage going down over time and you being able to refinance. So 2 to 4 units versus a single family residence. So on 2 to 4 units, you have higher cash flow potential, easier to qualify using rental income. Depreciation expenses can be used. So I'm not sure if you guys are aware of this. When you purchase a single family primary residence, you cannot depreciate the property, but you can if it's an investment. So even if you live there, because you can have an owner occupied situation with 2 to 4 units, or it could just be an investment property where you don't live there at all. But on either side, since if you owner occupied and the 3 other units in this example are considered like investment, then you can depreciate the property, which basically leads to your client or yourself or whoever is doing this purchase paying less money in taxes because they can depreciate the property. Faster income growth from rentals. So if you have a single family residence and you use that as income property, well, if that person moves out, then you have 2 months of not receiving any income, and that hurts really, really bad. If you have units and one tenant moves out or two tenant moves out, you still got other tenants that are paying you. So the impact is not as great. And when it comes down to raising rents and things like that, you have four doors to raise rents on versus one, right? So your income is going to grow a lot faster using having units versus a single family. So, and I also mentioned better against vacancies. So myth number 2, you need to share a wall if you buy units. Is that true or false? That is false. That is correct. Keep in mind, guys, 2 and 4 units come in all different types, shapes, and sizes and configurations, especially if we're in the Los Angeles area. I've seen a single family house with 2 units in the back that don't share a wall between the single family and the 2 units, but the 2 units in the back do share a wall. I've seen duplexes that are 2 houses on a lot or 3 houses on a lot, which would make it a triplex. So, you do not need to share a wall, which is a myth, okay? So today we're going to be covering financing options for 2 to 8 unit properties. Arlette's going to be covering FHA loans, conventional loans. Actually, Karen is out sick today, but I'll be covering that. Dewan is out today, but I'll be covering VA loans. DSCR loans will be covered by Ken, and self-employed loans as well by Ken. And the first person up to talk to you about some of our loan products, Arlette Hamilton. Introduce yourself and tell them what you're covering.
Hi, everyone. I'm Arlette. It is a pleasure to be here today. I love discussing real estate. I live and breathe the subject 7 days a week. This year, 2026, marks my 30th year in the business. I spent most of my career flipping houses, and now I wear a few different hats. I'm a UCLA grad with a BS in math and economics, so I enjoy numbers, and I was raised in a real estate family. My dad was a contractor, my mom was a broker, and growing up, my parents owned apartment buildings, so I got a chance to see them self-manage themselves. So when I got into the business, I followed their lead. So that's a little bit about me. What is house hacking? House hacking is a strategy where the owner lives in one unit while renting out the other units, and the rental income helps cover the mortgage and expenses. So in some cases, the owner can live for free or at a reduced cost. It's a great strategy for first-time buyers, and it allows you to build equity while your tenants help you pay down the mortgage. FHA. FHA allows borrowers to purchase 1 to 4 units with as little as 3.5%. So not just a single family house, 2 to 4 units. There's an occupancy requirement. So you must live in the property for at least 1 year. There are flexible credit guidelines with FHA, which means that the person can have a few lates on their credit. They can have a few 30 or 60-day lates or even a bankruptcy or a charge off, and they still might be able to qualify. High debt to income ratios are also not a problem. FHA will allow you to use the rental income on the property when you're purchasing to help you qualify. So that automatically is going to give the buyer a boost in income. So you can't go wrong there. And now if the building happens to be vacant, then the projected rents are used. So you don't have to use just your income. The borrower doesn't have to use just their income. Like Carlton mentioned, rents from the other units can also help them qualify. There's a vacancy factor that does come into play, but most of the rental income can be used to help your borrower qualify. Mortgage insurance is required on an FHA loan because the borrower is putting down less than 20%. So that's pretty standard. And there's also a self-sufficiency rule when you're purchasing 3 to 4 units. The property must be able to take care of itself. The rents on the property must take care of the entire mortgage. And if it falls short, then the property won't qualify. So it has to at least be able to cover the mortgage.
And before we continue, because this is FHA, which is the first loan program, I want to see if any of you guys have questions for Arlette about anything she just laid out here for FHA loans.
I had one question. So, the scenario Carlton you illustrated with the I guess the 4 unit building, and you with the 2,000 rent, where the borrower would have to come out of pocket 2,000. So I guess that scenario would not work for FHA, where the rents are not fully covering the full mortgage, because that's it's kind of hard to do, first starting out as a first year owner to break even with unit.
Oh, actually. Oh, in that scenario, they're going to use the income of the borrower. So that will help them, with all the 3 units plus the person buying the property, they are able to make the mortgage in that scenario because the borrower would have to at least have income, or I'm sorry, what were you saying?
Okay, so I'm getting so you excuse me. I thought you were saying that in order to buy the units going FHA, that the rents have to cover the mortgage outside of the buyer's income.
No, it would include the buyer's income.
Okay, that's okay. That's what I needed. Oh, clear. Okay,
Yeah,
like,
because
that's
they have to,
hard
yeah,
to do in LA.
right,
With
the number.
So okay, got you. Okay, cool.
Yeah, because the person's actually qualifying to buy the building, and so they're being qualified based on their income. But say they don't have 8,000, they aren't able to qualify with an $8,000 mortgage if they didn't buy a house and bought units, and they can show 6,000 on the other 3 units. That scenario would work.
Cool.
Yeah, and I just
Thank
want to make sure too, William, if you're talking about self-sufficiency though, which is the other aspect to this, right? In this scenario that's on the screen, if it basically so we have everybody paying $2,000 a month, right? This
Right.
third unit, even though it says the fourth unit, even though it says $2,000 a month, if it was market rent, it would probably be about 3,000. Okay. So all of these numbers together, 2,000, 2,000, 2,000, 6,000 plus another 3 is $9,000 times 75%. It would not be greater than $8,000 a month. So this scenario would not be self-sufficient. Okay. Which is why you'll need a conventional loan, which we will cover. To purchase this, you could go conventional, but you would not be able to go self-sufficient. Okay. So I just want to make sure that we.
That's so the self-sufficiency is another qualifying factor of FHA that just has to do with the property, right? It doesn't have anything to do with the income of the borrower, correct? From what you just said?
It's actually both. It's actually both. So it has to be self-sufficient and the borrower has to meet the debt to income ratio.
Okay, so then it wouldn't so that is a qualifying factor where, from the self-sufficiency standpoint, where the income from the units have to cover all of the mortgage, not considering the borrower's income, just the income from the property, the rents.
Yeah. So
is that how the
So what we're referring to, guys, if you guys are following this, is this last bullet point right here: FHA self-sufficiency for 3 to 4 units. This is calculated by using the appraiser's estimate of fair market rent from all units, including the unit occupied by the borrower, and subtracting the appraiser's estimate for vacancies and maintenance, or 25% of fair market rent. So that means that actually reading this is reminding me, let me go back. Since it's going to be the appraiser's opinion of fair market rent, these 2000s can actually be 3000 each.
It's not based on actual rent?
It's not based on actual, it's based on the appraiser's opinion of fair market rent. So that's something that we got to keep in mind.
Oh, okay, gotcha. Sorry. So this scenario is assuming all these units are vacant?
Well, essentially, when the appraiser appraises the property, he's going to appraise it as if these units are vacant, because it's the opinion of fair market rent. Now, keep in mind, some appraisers will say fair market rent is whatever the person's paying, right? And then some appraisers will say fair market rent is whatever somebody else would pay. So it gets very tricky with FHA. We're trying to meet self-sufficiency. Sometimes you got to have the right appraiser to make this thing happen, which Monarch Mortgage, we do have an AMC we work with, so we can ask these questions in advance. You know, hey, how much do you think it'll rent for? How much do you think it'll come out to be before we have the client invest the money and go out, okay? I don't want to get too tied up on self-sufficiency, though. We do have a question and answer segment towards the end. And so, but I do like that question. I want to make sure you guys understand that. But in most cases, when you're having issue with self-sufficiency, it's best to just go conventional. So we'll cover that in a second. Arlette, you can continue here.
Yeah. Big point about the vacancy factor, because like Carlton mentioned, the 75% of income generated from the place plus the person's what they're contributing is going to affect those numbers. Okay, FHA loans are an excellent product for duplexes or even a single family home with an ADU. FHA is very lenient, so you don't have to have an extremely high FICO score, and many loans can be approved with FICO as low as 580. This product is also great for single borrowers. For married couples, however, if one person has bad credit, then you have the option, the borrower has the option to exclude one spouse from the application, but because we live in a community property state, we'll have to put their debts on the loan. So the spouse with the bad credit doesn't have to be on the loan if the one spouse can qualify by themselves, but we will have to add the debts of the spouse with the bad credit. That's an FHA requirement. This chart highlights the various FHA loan limits. We have our standard mortgage loan limits on top and our high cost area limits below that. Now, most of the country falls under standard, but areas like Los Angeles, where we live, are considered high cost. And that's because our home prices are pretty expensive. You'll notice on our chart that the standard loan limit for units is $693,000. But here in Los Angeles, our maximum loan limit is higher. It's $1.5 million for 2 units. Also, if you look at the 4-unit column, you'll see the 1.04 million, that increases to 2.4 million here in Los Angeles.
All right. Well, thank you so much. And in those last slides, guys, keep the questions coming. I'm going to be, I'm not reintroducing myself because I just introduced myself, but we're going to jump into this next segment. Myth number 3, buying units are harder than buying a single family residence. What do you guys think? Are buying units harder?
Yes.
Can be, I would say, yeah.
You would say yes?
More involved. So, yes.
I think so.
Wow. You know what, guys? We got to help each other here, okay? Because I would say no to that. All right. Now, when we say harder is also relative, right? You got to keep in mind when you're
Right.
as a realtist, you're out there home shopping, right? And how much the rents are bringing in off the property. what are the tenants got going on, right? So in that aspect, yeah, it can be a little harder, right? But when it comes down to qualifying, when the bar using the borrower's income to help them afford the property, typically it's going to be easier for them to qualify than it would be. So maybe I should change the question, right? Is it easier to qualify? So that answer would be yes. But you're right. In some cases, it can be harder, but maybe not so much. Maybe you just need the right person guiding you. But let's go ahead and hop into
I have a
VA.
question.
Okay. Ronald,
Yeah.
did you have a
What do you
question?
have? Yes. What if you have those long-term tenants who are under rent control, and you need to show market rents, but you actually their actual rents are less because of rent control.
Yeah. So in those cases, so there's really nothing you could do to change actual rent, right? Maybe the FHA scenario could save you, where the appraiser could use market rent versus the actual. But in most cases, especially on conventional, there's not that opinion factor. They'll just use market rent, right? So in most cases, your borrower has to earn enough income to kind of cover that difference.
Are you saying, Carlton, that with FHA buying units that the appraisers will use market rents in place of the actual rents that the tenant is paying?
Correct. So let's go back to the FHA guideline real quick. Calculated by using the appraiser's estimate of fair market rental from all units. Okay. So they can. Now, if they're going to, is a whole different thing, William. So I want to make sure you guys understand that there's different appraisers that look at this guideline very differently, and I wish it was a little bit more spelled out, right? Because when they say using the appraiser's estimate of fair market rent, I mean that's their opinion, right? So
Right.
some appraisers will say market rent. Let's just say to Ronald's situation, somebody is paying $500 a month for a 2-unit apartment in 2026, right? Some
Mm,
appraiser will be like, hey, that's fair market rent because that's what they're paying, right? And some appraisers will be like, nah, fair market rent is what the market would
wi-
pay,
right.
right?
And that's what it
Which
is.
could be $2,500 to $3,000, right? So
Correct.
that's why when it comes down to going self-sufficient, either one, we have to vet like who the appraiser is, what do they think of fair market rent? Are you going to go off the actual? Are you going to go off the actual market? Right? You have to ask that question of the appraiser before they even get into appraising the property, or else hey, we might need a new appraiser, right? Or we have to go conventional, right? In most cases, the solution to the self-sufficiency rule is going to be to go conventional. But in Ronald's case, when he said that that unit had below market rents, it may be to come back to FHA, okay? Because that appraiser could give them more credit for the market rent than the person is actually paying. All right, let's jump into VA, guys. And I know some of you are trying to make these FHA loans work because you want that 3.5% down, but you can go 5% down going conventional. And and we can always look at scenarios outside of this. So, really quick, VA loans, guys. So, those of you who are veterans, VA loans have zero down payment. They do have an owner occupied requirement. They do not have any monthly mortgage insurance, so that saves the vet money. They have competitive interest rates, typically below FHA and conventional. They have no credit score requirement, but 580 and up is recommended for a VA loan. You must have 6 months reserves. Doesn't matter if it's a 2-unit or a 4-unit. The minimum is 6 months of reserves they have to have in the bank. So reserves is basically after the down payment, which is 0% on VA, after the closing costs, which is typically 2% of the purchase price, depending on the purchase price. After that, they have to have 6 months of mortgage payments, 6 months of reserves, right? If they have that, essentially they meet VA's requirements. VA does have a residual income calculation, but most people qualify for it. So as long as they have 6 months of reserves, they're pretty much good to go. So this is available to eligible veterans and service members. When you talk about 3 to 4 unit properties, because sometimes there's issues qualifying with FHA self-sufficiency, and sometimes The debt to income ratio could be high going conventional. If somebody's a veteran and they haven't used they haven't purchased a home, I do recommend looking at units for that vet first. Lower monthly payment, typically easier to qualify for on paper, okay? And and there's a lot of good benefits to it. The biggest thing, they have to have reserves, okay? Now, reserves can be a 401k or retirement plan, just to keep that in mind, because some people don't have liquid cash of I don't know, 30, 40,000 sitting in their bank account, but they may have stocks, they may have retirement, they may have things like that kind of set to the side that does have, that could be used as reserves. Okay. Any questions about VA before we move on? Okay. So just kind of comparing VA to FHA.
Yes.
Oh, go ahead. Jump on in. Who was that?
Yes. When you talk about, are you speaking of a market rate? Just say, for instance, they find something, say a duplex, and it's vacant. Are we talking about reserves based on market rate rents?
Neither,
Or
actually.
say, for instance, there's one. Okay, go ahead.
Yeah, so if a unit that has
So if it's like a
we're talking
two-bedroom each.
So hold on, Gwen, because you're I don't want you to confuse the audience, okay? The reserves are based off the monthly payment for the mortgage. Has nothing to do with if it's vacant or
Right.
not vacant or anything like that.
Okay.
So it's just the monthly payment of the mortgage. So
Okay.
let's say the monthly payment of the mortgage is $5,000 a month, and they need 6 months reserves. They need $30,000 in the bank account after closing. It
30,000.
goes off the monthly
Gotcha.
payment. Now, when you talk about
Gotcha.
occupied or vacant or market, that's a totally separate situation. You just need to have 6 months of the mortgage payment for a VA loan.
Okay. Well, thank you for clearing
Hey, no
that
problem.
up because I didn't know it was what it was based on. All right. Thank you.
No problem. So VA, 0 down payment, FHA, 3.5% down, self-sufficiency test. VA doesn't have one. So if you have a vet, VA does not have a self-sufficiency test. FHA does, and it's mandatory. By the way, if you are in escrow, if you're working with a different loan officer and they pre-approved you for 1.9 million for a 4-unit property, and it's a FHA loan, please know that a lot of loan officers, if they're not experienced, they don't even know this rule. Okay. You're going to go all the way through escrow and you're going to fall out. If you know FHA self-sufficiency, you need to bring it up and remind the loan officer about it. How are you guys going to address it? Because it is going to come up, and it's not going to come up until you get to underwriting. So if you've been pre-approved shopping, so I remind you guys, FHA self-sufficiency is important. Occupancy, must live in the unit, right? FHA or VA, borrower must live there, okay? Rental income use, VA allowed with a vacancy factor, FHA allowed but must pass self-sufficiency tests, okay? VA, no mortgage insurance, FHA, required mortgage insurance, okay? So let's jump to myth number 4. You need 20% to buy units. Do you need 20% down to buy units, guys?
No.
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 No, you do not. Okay. Conventional loans. Now, this is going to become probably something that I'm not even sure you guys know. So, you guys know you can put 5% down on a conventional loan now for a 2 to 4 unit property?
No, I didn't know that.
Yeah.
Okay. So, this is your answer to self-sufficiency. Go conventional, right? Fannie Mae, about a year ago, came out with a product that allows you to put 5% down on a 2 to 4 unit property. The only caveat is they must owner occupy. Okay. So if they owner occupy, they could put 5% down and boom, self-sufficiency is gone. You don't have to worry about that. Okay. As long as your income qualifies, they can purchase that property. Now, they do still need 6 months of reserves. And minimum credit score, even though people advertise 620, there is mortgage insurance on a conventional loan, and it does go by your down payment and your credit score. When your credit score is low as 620, it is extremely hard to even get mortgage insurance, which means you can't even do the loan. So I do recommend a 680 and up for a conventional loan. Even though they advertise 620, it is extremely hard to pull it off with a 620 credit score unless the person's putting 20% down, in which case You don't really need this loan type. But 5% down. Any questions about this part, putting 5% down on the conventional loan?
Mm-mm.
Do you guys think you could have a cosigner on a 5% down conventional loan? A
Yes.
non-occupying cosigner? Yes, you can.
Yes.
Yes,
Oh,
you can.
Yes.
So, we
yeah.
have a situation where I have a guy right now. He's self-employed. He only claimed $18,000 for the year, right? That's only like $1,500 a month. Mom makes $150,000 a month, but doesn't live there, right? So we added her as a non-occupying cosigner
Mhm.
to his file. They're going to put 5% down. He's the owner occupant. Mom co-signed. Boom, they're purchasing units. Okay.
Who has the 6 months reserve?
The actual borrower, the son does. Yeah, he's claiming 18,000, but
Wow.
he really made
Okay.
100.
Go ahead.
Really, he's making like $150,000 a year. But because you're self-employed, you write off everything. We're all self-employed here, so we all know this game. Okay, you write off everything, right? So
Right.
he has money.
Exactly.
Yeah, he has money in the bank, so he had the reserves.
They
Saved up.
they
All
wouldn't
right.
have the reserves of the non-occupant co-borrower.
You know what? That's a good question. I don't know the answer to that, but I believe they would use the reserves of the non-occupying co-borrower.
Yeah, they should because that helps out a lot.
Exactly. Okay. Possible lower mortgage insurance compared to FHA going conventional. Depends on the credit score, guys. Stricter credit and income requirements going conventional, though. Higher down payment than FHA VA going conventional, but it's a good option for strong borrowers, meaning strong credit scores, available for owner occupied and investment properties. So now we're crossing over from somebody living there to somebody not living there a little bit. But before we do, myth number 5. You need experience as a landlord to purchase units. True or false? Don't get shy now.
Learn on the fly.
Learn as you go.
You learn as you go. You're absolutely right. So that means you do not have to have experience as a landlord to purchase units. VA does have a requirement for you to have a landlord experience. However, you can use a property management company to circumvent that guideline and still close. And, if you decided to fire the property management company after closing, that's up to you. But Ken Smith. So we have our next segment coming
Great
up.
idea.
Before I jump to Ken, though, real quick, conventional. Will, I'm sorry, I didn't catch what you said. I just want to make sure. Any other questions about the conventional loan?
No.
No for Gwen. Will, did you say something? If not, we're moving along. So, Ken,
Said
oh, sorry.
that's part of property management after you close.
Hey, we
You
gotta
gotta do what you gotta do to close it.
You got to do what you got to do. I hired a property management company and paid them for 5 days. whatever it takes, you could get to close the loan, though. Okay. So I'm bringing in Ken Smith to talk to you guys. Ken, go ahead and introduce yourself, and we'll get
Creative
Hello, hello. Good morning, everyone. I'm glad to see you all showed up for this seminar. I see there's a few people on here I know pretty well. I'm glad you guys signed up for this. I am Ken Smith. I'm a senior loan officer here with Monarch. I've been in the business for over close to 30 years. I'm originally from Detroit, Michigan. I came out here over 30 years ago. I graduated from Michigan State. I have a business degree in logistics, materials and logistics management, and I was in procurement for a long time in Detroit, well, for several years before I moved out here and decided to pursue a career in real estate. And ever since then, I've loved it. I've been selling real estate for a long time, and I did a lot of flipping for over 10 years, and now I'm doing loans. So I love it. I love everything related to real estate. So today I'm going to cover some real important programs that are helpful for people who are self-employed and they're non-QM programs or non-qualifying programs. So the first one I'm going to cover for you all today is DSCR, and it stands for Debt Service Coverage Ratio Loan. Now this is a great program for people who are self-employed and you write off everything, which is pretty much almost everybody on this conversation. You qualify. The qualification is based on the property cash flow, not on you personally. You don't even have to have a job to get this loan. So when you go places and you hear people who own 10 units, they say they own 60 units, 70 units, nine pieces of properties, but they got 80 doors, 90 doors. In most cases, this is the loan they're using to get all these properties. They're doing DSCR because you don't have to qualify, you don't have to have a job, as long as the rents, the income qualifies, the property qualifies, and you've got the down payment and the credit, you can get this loan. And so no personal income verification required. Great for investors. A higher interest rate, but typically requires a larger down payment. So these DSCR loans, now you can go as low as 15%. They range anywhere typically from 15 to 20%, just depending on what your credit is. But it's a good way to go. And basically it's a 1-to-1 ratio, just so you know. So we'll cover that in a minute. So it's 50% minimum down payment. You use the rental income to qualify, as you can see. The rental income typically needs to be greater than the mortgage payment. That's the 1-to-1 ratio. So if the PITI is, just using this example, is $5,000 a month, then the combined rental income needs to be at least $5,000 a month. There are some DSCRs that will go below a 1-to-1 ratio. But obviously the rate is you're gonna take a hit on the rate for that. And then you got some that have no ratios. Then you take another hit for that. But they're out there. So lower ratios than 0.75 and no ratios and lower. So all that's available to you as well. You typically need a FICO score about a 660 to 680 to go for DSCR, just so you know. And the minimum down payment about 15%. Now, regarding this, the first-time home buyers are allowed. They will take a first-time home buyer. First-time home buyers are allowed. First-time investors are allowed. The borrower does not need income or job, as I mentioned earlier, related to this DSCR. And
we're going to jump to 5 to 8 after this. So I want to see, does anybody have any questions for Ken about DSCR loans? Because this is very underutilized and very major for people that have good credit scores but don't have good income on paper. So any questions for Ken?
Do you need reserves?
Yes, so some of the DSCRs, they're going to vary. Some will require 2-3 months reserve. Some require 6 months reserve. So it varies. You just have to check with that lender. But it's anywhere typically between 2 months to 6 months reserve, depending on the lender.
What type of interest?
Does it have to be owner occupied?
DSCR, you cannot live in the place. It's an investment property.
Okay.
What type of interest rates are we talking about?
So William, you're going to be looking at, you're going to be probably, depending on your credit, you're going to be somewhere in the 8% range, typically low 8s, maybe high 7s to mid 8s. But it's a stated income program, so it's not a full doc.
Amortized over 30 years?
Yep, amortized over 30 years.
Can those reserves be verified via a gift letter? And if
Ron,
so,
yes, it can be verified via gift letter. Correct.
Okay. And how about the seasoning of the gift letter?
Well, I'm not sure on the seasoning. I'd have to check on that. But typically, if they allow you to do it, you just have to source it. You have to be able to source where it came from. If you can source it, in some cases, it may not require any seasoning. So it's a case by case. Different lenders have different requirements on how they're going to treat that gift letter. So you just have to, check on it based on that particular lender.
Thank you.
Can you have a co-borrower who, like a regular W-2 person, buy, or is it just, or not?
You have to be self-employed for these programs.
Okay.
So they can be a W-2, but they got to have a self-employed gig on the side that they're doing this under.
So I'm sorry, that part. Okay, so hold on, let's back up. When we do these applications, guys, for DSCR, it doesn't matter if they're self-employed or W-2.
That's right. They don't even put it on there.
We have to delete the employment information off the application to even submit it. So that lets you know they don't care about the income of the borrower. They don't care about the job of the borrower. Matter of fact, it can't be on the application. I accidentally submitted an application with the income on there. The bank declined it. delete the income and have to resubmit it to the bank.
Okay.
So they
Very,
cannot
very common
have
mistake. We all do it.
yeah,
Exactly.
yeah.
All
So,
that's got to be gone. All that's got to be gone. So, based to your question, it's really irrelevant what he's saying. It's irrelevant because they're not looking at anything income related to the borrower.
Okay.
It's all based on the property.
Thank you.
So as long as that borrower has the reserves.
The building has enough income on it, they'll qualify.
Okay.
That's the key. That's the most important driver. What does the income
Okay.
the building is generating?
Mm-hmm.
Mm-hmm. Hmm.
I love it, Ken. There's a
So
lot.
why would you go with this as opposed to a conventional? Say you want to buy 4 units, Ken. Why would you go with the DSCR loan? And just say you could go either way. You qualify, you know what I mean? What would be the benefit of doing
Well,
a
just so
DSCR?
you know, if someone could qualify conventional, they're most likely going to do it if they can, because the conventional rate's going to be lower than a DSCR
Right.
rate. So this is designed for people who really can't qualify any other way. They don't have a job, or they don't show any income on their taxes, but they want to buy these 4 units.
Okay, got it. Makes sense.
Mm-hmm.
I got a guy right now that make a lot
Any
of
other
money,
questions, folks?
and he does not want to go through full documentation. He just doesn't want to deal with it. He just give me a DSCR loan. The property qualifies based on rents, and just make it easy for me. I plan on selling it in 6 months to a year anyway, right? So that's just an example. Sometimes when you're self-employed, and especially people that are high net income individuals, the headache is worse than the you know what I mean, the headache of getting a full document. Some people would rather just go with a DSCR and not do a full document just to close the loan,
You bring a good point up, Carlton. With that said, what's the turn times to close the DSCR? I assume they're faster than conventional, right?
Yeah, so the DSCR, the turn time on is going to be pretty quick. If the property doesn't have any major issues, that's another thing. The property has to be in good condition, because if the property has a lot of issues going on, structural leak in the roof, foundation issues, then they're going to require that to be fixed before the loan closes. So assuming the property's in good condition, assuming the rents are excellent, you can close the DSCR easily in 2.5 weeks.
Nice.
Mm-hmm.
Are these loans featured in other states, Ken?
Pardon me?
Is this type of loan featured in other states, like on the East Coast?
Yes, it's available. It's available in all around the country, in various parts of the country. Absolutely.
Matter of fact, Gwen, when you talk about that, I'm glad you asked that question, because DSCR is considered a business purpose loan. We are not even required to be licensed in those states to do this loan. So that means that we could do loans in more in states that we're not even licensed in. So for example, I'm doing a DSCR in Tennessee right now. I'm not licensed in Tennessee. Okay.
Wow.
But because it's a business purpose loan, it's not required that your mortgage company is licensed in that state. So we can do loans, and it all depends. Some states do have a requirement that you have to be licensed, but most of them do not. So if you have a situation for DSCR
most of them
in a
don't.
different
Exactly.
state, you might want to let us know that's what you're looking to do, because it does not have a licensing requirement.
Yes.
Interesting.
Can you buy commercial properties with this DSCR loan?
Yes, you can.
I'm going to use that as a transition to the next
It's like
slide.
a commercial building, just a building, not units, but a building.
Right.
Commercial building.
But I'll cover that now. So you're getting into commercial area when you go to 5 to 8 units. So you could do a DSCR for a automotive shop. If the automotive shop has enough income coming in and make the payment for that building, it'll qualify. So it can actually be, it doesn't even have to be residential. It can actually be a commercial structure. But we're talking specifically for 5 to 8 unit residential right now. So here you're going to need at least a 7. Go ahead. I'm sorry. Any questions?
That DSCR acronym, what does it mean again? Debt service what?
Service coverage ratio.
Coverage. Okay. Thank you.
Yeah, and it's typically 1-to-1 ratio. So now we're going to cover the DSCR 5 to 8 units. So now when you go up to more units, the threshold is a little bit higher now. Now you need at least a 700 FICO score to go between 5 to 8 units. You're going to need a minimum down payment of 25%. And first-time home buyers are not allowed. First-time investors are not allowed. They want to know you've got experience doing this before, and you've done this before. Go ahead.
Do they want experience in the commercial realm, or can you show experience in the residential income realm?
They want to see experience in the commercial realm, that you've bought something between 5 to 8 units before. That this is not your first time buying because after 5 units and up is considered commercial property. So that's considered.
Oh, they want commercial experience.
Yeah,
So
because you're buying a commercial unit.
Game, you can't use this. If you're trying to buy your first 5 unit building, you wouldn't be able to use this program, huh?
You know, if you're trying to buy your first 5 unit building and you haven't ever bought anything between 5 to 8 units, and I'd have to check. Sometimes they make exceptions if you bought, say, a 3 unit building or a 4 unit building. I have to double check lender to lender. But typically, you definitely got to show some experience buying units before. Can't be your first time buying units.
Occupant co-borrower?
Pardon me?
Will they take a non-occupant co-borrower? Say,
yep, they would. They would.
Or that does have experience.
That's right. They would. They would. Absolutely. That's what a lot of people do. They just add someone on as because keep in mind, you're both are going to be non-occupant because the DSCR loan. But a lot of people add a co-borrower that does have the experience to it, so they can qualify.
That makes sense.
Mm-hmm. And so the borrower does not need income or a job again. Don't even have to have a job. Rents need to cover the mortgage and the utilities.
Wow.
So the PITI
and utilities.
And utilities. Yes.
We've had some banks that have gone put it in should be an asterisk, not a quotation, because some banks don't require the utilities and some banks do. So
that's right.
we're a mortgage broker. We're approved with over 50 banks. So different banks have different requirements that we work with.
Yes.
Mm-hmm.
This program is like a lot of other programs. Different banks have different overrides for their programs. Some don't have those overrides and some do. Any questions, folks?
Is this typically a portfolio product, or are they selling a 2 to 4 unit? Are they selling it on the secondary market, or are they housing the paper?
It varies, but in most cases, it depends on the lender. Some lender will service the lenders and some the loans, and some will sell it. But it could be either one. It depends on the lender you're working with.
Yeah, because sometimes the qualifying criteria is not as harsh when they're
keeping the paper
portfolio.
That's right.
There's no override, no overlays.
That's right.
Yeah.
Hey, and Ken, I just saw an email from UWM this morning. They have a 40-year interest-only DSCR product now.
Oh my God, not a 40-year.
A 40-year what? You say it's a 40-year what?
Good.
Interest only or principal and interest DSCR.
Wow.
So you can take a DSCR to 40 years now.
Wow.
So you're not capped at 30. Now, Gwen, because I heard you say, not 40 years. So you know what? When you look at interest and stuff, it doesn't always make sense. But keep in mind, this is an investment. So most people are trying to make that money, that difference off of what the mortgage is versus what they're charging. They care about more of that when it's an investment and their strategy is to hold it. That may be perfect for some people. Some people care about paying it off sooner, and some people, hey, if I'm 70 years old, do I need a 30-year mortgage? So some people don't, or do I care about a 40-year mortgage? Some people don't care.
Right.
Mm-hmm.
Yeah. Some people they're just more interested in making sure that payment is low enough where their rents are covering it, or the rent is exceeding it, ideally.
Yep.
And then you have the tax write-off on top of that.
Okay. All right. So now, folks, we're going to go over to another really popular non-QM program. This is called bank statement loans. So for people who actually do have businesses they can show a lot of income coming through their bank statements, coming through their bank account, you can use this program. The lenders just require a minimum of 15 to 20% down. They're going to ask for at least 12 to 24 months of bank statements. No tax returns are required. It's great for self-employed borrowers. The income is calculated from the deposits, higher down payment and rate. And even related to this, it may be on the next slide, you can have your CPA or your CTAC issue a letter stating that you operate your business at 10%, at only 10%. If you show that you can operate it at 10%, which it says here at the bottom, they'll maximize your income all the way to the very most, to the highest amount. So this is another great way of going non-QM. If you got income, but you don't want to show your taxes, but you can show the cash is coming through your account every single month. This is a great bank statement loan program. Great way to buy.
Now for this one, I think
questions?
you do have to be self-employed for bank statements, Ken. So that came up earlier. So that's where that comes in.
Right.
Some bank statements, they want you to be self-employed, not W-2. Any questions about bank statement loans for Ken? No? Okay. Just so you know, rates are getting so good on DSCR. Most people are going that direction versus going bank statement. But, some cases, let's say you want to owner occupy, you can still do that on a bank statement loan. Okay. So DSCR, you cannot owner occupy.
That's right. So these other ones we're covering, the bank statement program, there's 1099. Go back to that for me, please. The 1099 and the P&Ls, these you can occupy the place. Unlike the DSCR, you can't occupy those. So this last one I'm going to talk about is another non-QM program, 1099 income or P&L statements. And it's designed for self-employed people. The 1099, you're just using your 1099 income instead of your tax returns. They're going to look at it for the last year or 2 years and take an average. Flexible income qualifications, the rates are higher than conventional loans and ideal for entrepreneurs and contractors. Now, the profit and loss statement, they're going to want you to produce your CTAC or your CPA to produce 12 months to 24 months of profit and loss statements for your business. And based on that, that's the beauty of it. You get to state to the lender, you get to give them the income you want to show. You show what you want to show, and they let you select your own tax preparer to put it together. And they'll qualify you with that P&L, with those P&Ls, if the average is there. But you still have to have the credit of 660, 680, somewhere in there, and you still have to have the down payment you need, which is typically going to be around 15, 20%. But these are also some good ways to go, 1099s or P&L statements. I did a loan for a guy recently, P&L, and he had a business that was actually losing. But, he had his CTAC person show. He was making a lot of money, $1 million a month, and he got a $700,000.
And what's the down payment amount for this loan?
15 to 20%. For these,
that's a lot of skin in the game. Yeah, I'm going to try to lose that.
and of course, you can do these programs not just with purchase money loan. You can do them with refis. The example I just gave you in Venice, that was a refi. He was pulling out $700,000. So as you can see, these are the key takeaways. Multi-unit properties accelerate your wealth building. Absolutely. You're going to extra help with the income coming in. But it's counterintuitive. A lot of people don't think like that, but that's really actually what's going to really accelerate your wealth versus buying a house or a condo. House hacking reduces living expenses. And then you've got multiple loan options available for different borrowers' profiles. So we got a lot of different ways we can help you. Basically, folks, if your people got any kind of decent credit, they got a little bit of money and they got a pulse, we can get them a loan. Just call us. We'll make it happen. We even have other borrowers that we're not talking about here that are going to be basically in the area of bridge loans and hard money loans that you can discuss with me if they just have really jacked up credit and they can't qualify for any of these. Reach out to me and I'll let you know about it. It's ideal. These programs are ideal for first-time buyers, experienced investors, and the education and proper financing are key to the success. Any questions, folks?
Well, with no questions, we're going to come back to some more. I do want to let you guys know if you don't have our contact information or you don't have our application, right now it's a good time to go ahead and pull out your phone and scan the QR codes. I think this is actually the Apply Now link, which could help you guys. We have a very great software at Monarch Mortgage where we can put you in as a realtor-realtist partner. give you your own link. So whenever you send it
Mm-hmm.
out, they'll see your face, they'll see my face or Ken's face or Arlette's face, depending on who you're working with. So you can have your own link for your applications that co-brand you on it. So yeah, feel free to let us know if you need any of our information. So this is the question and answer segment, and we're in the process of closing. I'm going to actually go back to our contact card while we see if anyone has any questions. First of all, did this help any of you guys?
Oh yeah.
Yes, absolutely.
Definitely, yes.
Great information. Yes.
Great information.
When we first started these workshops, guys, I was like, I don't even know if people are going to see value in this. We don't know what you know. But I'm glad that we did it because we're getting a lot of good feedback. And yeah, so
Now, all the lenders at Monarch are experienced in all these different programs that you offer?
Is very
or you guys kind of work together?
all of the above. Okay, so my goal on with the team is that everybody has their strengths and weaknesses. Okay, but however, we all work together. We go through trainings every other day, basically. So Tuesdays and Thursdays at 1 o'clock, my whole team is together going over stuff like this. So that way, when we receive an application, there's no difference in working with Ken versus working with Arlette. So yeah.
You kind of cut out, Carlton, when.
Oh, apologies.
Can you repeat that?
Yeah, I was just saying that. I'm sorry. Can you hear me okay?
Yes.
Okay. So I was just saying that we go through trainings every Tuesday and Thursday just for that very fact. I think, yeah, there's Gwen, because we want to make sure that no matter who you work with, everybody can close your loan, right? Or has the ability to reach out to an underwriter or whoever that they need to make sure we can close. So yes, we are all basically on the same level when it comes down to getting your loan closed, okay?
Awesome.
And Carlin, this is your company. You're the the owner or whatever. Or,
it's funny that you mentioned. I wasn't gonna say it again, man, but your boy kind of.
Yeah, he's the head honcho.
Hey, I've seen the progression. Hey, come on, iron sharpens iron, bro. Like, you know what I'm saying?
Yeah. But congratulations to Monarch, and welcome to Inglewood.
Oh, absolutely. Yeah.
We appreciate
you guys
it.
don't know we have a brick and mortar office here in Inglewood, right next to Fiesta Martin on Van Ness Boulevard. If you guys are ever in the area, feel free to swing in. Don't swing in like we ain't doing nothing because we be busy. But swing in, say hi, all that good stuff. But yes, we're here. And we're going to be here to stay. So, we got more workshops, guys, that we're going to be coming out with throughout the year. Some of my team members couldn't make it today, but we have a lot of stuff planned that we're going to be rolling out. As you guys have loan scenarios, questions, feel free to reach out to the loan officer on my team. We're doing a lot of great business. If you got to deal with another loan officer and you want to know if we can beat it, let us know. We'll be happy to go through that scenario and look at if we can offer better pricing. Typically, we can. So a lot of great things happening here at Monarch Mortgage. Any other questions, though? Let me go back to the.
This was a very good, important subject matter. That it's great that you took the time to offer it at the beginning of the year. So we're looking forward to doing business with you and closing some deals in 2026 for sure.
Oh, absolutely.
And you guys just know this information we shared with you. You all know more than 80-90% of the realtors out here now. 80-90% of them. So you're ahead of the pack. So as you're talking to your prospects, you're armed with all kind of knowledge of how you can put deals together that they're in the dark about. So that gives you an edge. It gives you an edge, and you got us to come to you got us to come back to help you close those deals.
Right.
So reach out to us.
Coming to the seminars, workshops, and learning.
Thank you on that.
Yeah. No, this is great. Carlton, Ken. I was meeting Arlette, but Carl, I'm really proud of you, bro. Like I've seen the progression, man, and I see you've added some key players to your establishment, and I like how you guys talked about loans outside of traditional 30-year fixed, FHA conventional, because these are some real creative loan programs that can help us out
Mhm.
as agents getting either listing closed or buyer qualified. So kudos, and I gotta hop off, but keep me abreast of upcoming Zoom and seminars, man. Y'all doing a good job.
Hey, thank you, Will. Appreciate you.
We'll keep you in the loop, Will.
Thank you.
Appreciate it.
All right.
Yeah, we still keeping it going, guys. Any other
Will the
questions?
slides be available? Are you going to send the slides out?
Yes, our plan is we didn't record the last one, so we recorded this one. So our plan is to
Okay.
send out the recording. It may have to be edited, but
Mhm. No
with
problem. The
our
slides is good. I love your slides.
okay,
And
great.
Arnett,
Great.
kudos to you. I know you come from the other side of the fence, being an investor. Now you're doing loans. I think it's awesome.
Thanks. And I'm still doing investments. So now
I
that
know
you
you are,
out,
girl.
it's
You
like
never
I
stop
can do it
being an
all.
investor.
7 days
Yeah.
a
So
week with real.
in other words, you have first-hand experience
Yeah, with units.
buying property,
Yeah.
investment property, and using these different creative ways in buying them. So yeah,
Yeah.
kudos to you.
Thank you.
All right. Well, thanks so much, and see everybody at a closing.
Thanks for
Let's
coming.
Okay,
Appreciate
nice
it.
seeing you,
Thank
Ken.
you.
Daryl,
All right.
Pam, Souza, John. Any other questions you guys have before we conclude?
No, I don't have any questions, but I thank you for presenting this. I've had heard of the DSCR loan, but I didn't know how it works. So even though I've been in the business a long time, I learned something new today. So that was really good.
I'm glad you joined, Pam. I know I haven't talked to you in a long time. Glad
Yeah,
you
it's
joined.
been years.
It's been years. That's right.
I like that also, Ken.
All right. I appreciate it. Hey, Ron, good talking to you. I'm glad you joined.
Absolute.
Daryl, you have
I
anything?
don't have any questions, but thank you. No, thank you for the performance. Giving us this information does give us a lot of ammunition for our clients to kind of get them off the fence. So I look forward to closing some deals with you guys.
Oh, absolutely, brother. All right, cool. Well, hearing no other questions, thank you guys for attending today, debunking the myths on buying units. I hope you guys enjoyed it. Carry on with your day. Share the news. Don't be silent. We'll be emailing you guys the slides and also the recording of the presentation. And I look forward to closing with you
All right,
guys.
everyone, take care.
Okay.
All right. All right.
Thank you.
Be well.